In today's video, I am going to be breaking down a high dividend ETF portfolio that I've picked out myself as to basically give you the ability to make huge dividends and, of course, grow your money safely. These are my own choices, so make sure to do your own research, and I hope that this video does help you. Let's get down, let's check these out. This first ETF is NXF. It's a fantastic ETF that you can get. It's obviously in Canada, and basically what this ETF does is it follows the energy giants, and it is a covered call strategy. Basically, what a covered call strategy is, if you don't already know, is basically you hold shares, or in this case, the ETF will hold shares, and they will sell call options against those shares. Those call options sell for a premium, and of course, that's where a massive portion of the dividends or the yield come from, is that premium from the call options. It's essentially, in a long story short kind of case scenario, basically you are playing casino with energy stocks. If you want to know more about covered call strategies, I do have basically a brief summary on this channel as a video as well. If I remember, it will be tagged too. But this one is hedged to the Canadian dollar, so you don't have to worry about all those currency games that, of course, the world plays. This does have an 8.3% yield over the past year, and the average volume is quite high at 79,000 shares traded per day, so it's pretty easy to get in and out of. And it has an MER of 0.72, which is a bit high. So essentially, for every $100 that you have invested, you essentially are going to be paying 72 cents. And of course, if this grows to $1,000 at that point, you would then be paying them $7.20 for every $1,000 you have invested. Yes, there are ETFs that are much cheaper, but generally not call option ETFs. The cheapest one I've seen as a call option is around 0.6 something percent. It's because of those call options that they are doing. They take up a lot of time, and they want to get paid for their time investing. Now, we have to remember that this was when oil went negative, and the recovery has been quite good. Beforehand, Trump was in office, and of course, he was mining oil, or at least companies in his nation were mining oil like crazy, which was bringing down the price of oil, which was also bringing down the price of oil stocks. So that's why this wasn't so good. But now with Trudeau and Biden in office cutting back on oil mining, we can see the price of gas, oil, and of course oil stocks continuing to rise. These are the dividends that of course they have been paying. It's a quarterly dividend, and if we go year over year, there is some growth in the yield as well, which is what we really want to see. Some of the top companies that they hold are these, and some of them we may have already heard a lot about. Canadian Natural Resources, CNQ. This is a company that I used to invest in. I no longer hold it. However, I do hold ETFs like this one that do hold that stock. Occidental is a company that Jim Cramer used to be going crazy about. Now, everyone has different thoughts on Jim Cramer, but I usually do the complete opposite as to what he usually mentions to do. And oddly enough, Jim Cramer really hasn't talked a ton about oil stocks recently, so it's kind of interesting. He kind of like picks the losers, which is kind of interesting. The next ETF is the Vanguard Canadian High Dividend Yield ETF, VDY is its ticker. This one doesn't have the same crazy high yield as the last ETF we just talked about, but at 3.8%, you don't have to worry about the covered call strategy, which everyone has a different opinion on it. And you're holding an ETF that holds specific stocks and obviously not worrying about options. This one does have an MER of 0.21%, so it's also a lot cheaper than a covered call strategy ETF, and the average volume is much higher at 140,000 shares traded every single day. Now, recently this ETF has exploded with the market. And of course, most of this explosion to the upside has been financials and oil stocks in Canada. This is obviously a Canadian ETF. And the reason why this wasn't doing so well back before the virus is because, of course, the banks were pretty much stagnant unless you had National Bank, in which case it was actually one of the few banks of the big six that were actually going up during that time. That is why this ETF was basically stagnant in a way, of course, up until just before the virus hit. And that is, of course, mostly because a large holding percentage of this ETF is banks. The nice, beautiful thing with this ETF is the fact that it pays monthly. So if you were looking as an income replacement, maybe if you are retired, or if you own your own business like myself and you just wanted to have some stability with your income, then something like this could help you a ton. For myself, I invest in this ETF and many others that pay monthly, mostly for that one reason, and that is, let's say I have one really bad month and I just need to get some money. Well, guess what? These dividends can help you with that. So that's why I personally I like personally monthly paying dividends, because of that reason alone. And of course, if we compare this year over year, we can see that the dividend did increase, but so did pretty much every other dividend in Canada, especially when it comes to the banks. And the top 10 holdings consist of a lot of banks. We've got Royal Bank of Canada, TD Bank, Bank of Nova Scotia, Bank of Montreal, CIBC. These are all banks. Other financials that are on this list is Manulife Financial Corp, which is kind of like an insurance company up here. And then, of course, we have energy stocks. And now I wouldn't necessarily call them oil stocks because, of course, Enbridge is traditionally an oil stock. However, with Enbridge, what you are getting is a company that is investing into solar. And, of course, they do have pipelines, so keep that in mind. That's still a major part of their business. Same as TC, which is TransCanada, major into oil and gas distribution. However, at the same time, they are also investing in solar panels, wind farms, things like that. And then the one company that I highly disagree with is Bell, BCE. Of course, I use their services, but they own different TV stations that I highly disagree with. And of course, they are seeing a lot of competition with stuff like SpaceX. I am still on the belief that SpaceX is going to absolutely own the world internet. And of course, that is going to probably be over the next 10 years. Don't ever bet against Elon Musk. He will literally put you out of business. Next is ZRE. This one is a BMO equal weight REIT index ETF. As you can see, we are being really diverse. So far, we've basically looked at an ETF that covers oil stocks, another ETF that covers a broad market Canadian market, and mostly banks, and then we have this one, which is REITs. This is like rental properties. This one has a 4.2% yield. It does pay monthly as well. Now, because it's a REIT ETF, you'll generally see a higher MER, and this one's a 0.61%. And you're seeing an average volume of 28,000 shares per day, which if you're looking to buy maybe 100 shares or 1,000 shares, you're not going to have to worry about the liquidity. But if you're able to buy like 10,000 or 5,000 shares, at that point, you're going to see some issues trying to get in and out of it. Of course, they got hammered when the virus happened. This was doing actually quite well beforehand, and if you could have bought it down there, that would have been just absolutely amazing. But since then, they have recovered, and now they're starting to stagnate out. However, one thing that I do want to mention is this, and that is, this is really starting to line up into something that is quite interesting. If this line breaks above here, then it's going to go to the upside. If, however, it breaks below that line, it's going to continue down. And sometimes REIT ETFs like this one, as it is an equal weight, basically is a good indicator as to where the investors or the rich billionaires who invest in the market kind of think where the economy is going. And now this one is basically mirroring a lot of Canadian real estate, and because of that, I would really start looking at ETFs like this to see where the future lies. If this ETF breaks below that bottom line, that may show, in my opinion, what may be a negative outlook for the Canadian economy. And with what's going on in Ottawa right now, I would actually think that this could kind of scare some investors between the Emergencies Act that is currently being implemented, plus the fact that inflation is so high and that interest rates are starting to rise too. This could kind of start, or at least show, what could be negative in the Canadian marketplace coming soon. The reason why I mentioned the Emergencies Act is because if we're looking at the banking system, the financial system, and we're seeing that the government could technically take anyone's money away at any given time, including businesses, what that is telling investors is maybe this is not such a stable place to keep my money, and there are better opportunities, potentially other places in the world, in which case, if that was to happen, there would be a pretty good outflow of cash going out of the country, which could, of course, deflate or at least lower the currency value of Canadian dollars, which would be pretty bad for inflation here, even on top of that, mainly because we buy a lot of our stuff from the States and from around the world, and that could just artificially increase the price of those items because, of course, if our money isn't buying as much as it normally could, then at that point, it would not be very good. And if our currency value goes down, then that is going to be even pushing more people out of the Canadian economy when it comes to investing. And if that is the case, it doesn't look very good. This could literally be the start of a very, very bad recession. We just don't know yet. And this is one of those things that we can look at and really say, well, it can give us at least an idea as to where people are starting to think the economy is starting to go. REITs, real estate, generally gets hit first. This one's nice because it does pay a 9-cent dividend every single month. Just don't expect it to raise their dividend very often. However, we have also seen that it's not been such a great time to raise a dividend when it comes to REITs anyways right now. Some of its top holdings are some of the most interesting holdings in my opinion. Of course, there's RioCan, which holds a ton of different store type real estate, strip malls, places where you'll see a Best Buy, malls in general. Kind of an interesting holding right there, because if we do see a somewhat kind of a recession, that will be hit first. However, if we start looking at apartment real estate, when it comes to apartments, it's actually quite interesting because now a recession actually helps that industry because they're going to get rid of a lot of their older tenants who may have been living there for 5 to 10 years. And I used to know an older gentleman who owned a lot of apartment buildings, and he said you actually make more money in a recession going out of a recession than you did going into a recession, because you're going to be basically removing a lot of clients or a lot of tenants who can't pay their bill to live there anymore. And then when you get new clients in, you can raise the rent to where market value is today. And of course, if you can only raise your rent 2 or 3%, I can't remember what the rule is here in Canada, per year for existing clients or existing people who live in your apartment. But as soon as they move out, you can put it up to market value. At that point in time, you could be making upwards of $500 to $700 more a month on that same apartment building or that same apartment itself. And this is how it was explained to me from that older gentleman who I used to know, who's passed away now. However, this is still a very, very interesting market, because if this is leading into a recession, you generally will make more money coming out of that recession with REITs. Next is the CI Tech Giants covered call. Of course, now we're looking at technology stocks. This is a covered call strategy. It's TXF is the ticker, and 68,000 shares traded per day, so it's pretty liquid. A massive 10% dividend over the past year. This is going to give you massive, massive income. Of course, just like tech stocks, this has also been dropping as well, and we don't know how far obviously tech stocks are going to drop. However, this is something that you could buy a little bit at a time until it gets down to a point where you feel comfortable putting a little bit more money into. We don't know when this is going to recover. It could recover literally tomorrow. Well, we just don't know yet. But this could be a good way to kind of store your money as it may recover in the future. Tech stocks obviously will, and you're getting paid a massive dividend during that time. As we can see, massive dividends. Of course, dividends are going to be lower than they were last year, mainly because, of course, the volatility is just not there. AMD is one of the top holdings. My favorite is, of course, Nvidia. My least favorite is Facebook because I just can't stand using that platform anymore. However, Texas Instruments, Nvidia, as well as AMD are kind of the top names. They're chip stocks. There's a reason for that. It's because there's a shortage of chips, and that's not going to change anytime soon, in my opinion. And of course, we need something in the US market other than tech, and that is going to be the US high dividend covered call ETF. Again, I like the covered calls. This one pays 6% over the past year, 37,000 shares traded on average every single day. Now, the one thing I really do like about this one is its consistent growth over time. Over the past year, however, or 5 years, we can see that it was just a very slow growth before the virus hit. And then since then, it's been some pretty steady growth. Of course, right now it's kind of leveling off because tech is not having a great time right now. You do get a monthly dividend, and it's one of the few BMO covered calls that has not dropped its dividend because of volatility, so 11 cents per month. Not too sure if they'll drop that in the future, but still something to really look at. Its top holdings are generally the top holdings in the United States, and what we can see here is Microsoft, Apple, top two. That is an obvious. Oil stock, which should be doing quite well because of the price of oil. Coca-Cola is a Warren Buffett stock. And I think Home Depot, as well as Lowe's, even though Lowe's is not on this top 10 list, will do extremely well because of the fact that there's more homes that need to be built and renovated. And just overall fantastic set of companies. And of course, you can have your own opinion on that one. I hope that you've enjoyed today's video. If you have, hit that like button and subscribe. Let us know your comments down in the comment section below, and I'll see you guys again next time.